I'm going to tell you the three must-have qualities that a fund manager must have in order for you to, benefit from selecting him. Hi, my name is Gary Mishuris. I'm the managing partner and chief investment officer at Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So recently I was talking to someone and they asked me, how do I choose a fund manager? And it's a hard question because I think many people in this space use exactly the wrong approach. And here's what they do. What they do is they say, well, who has the best record? And usually they mean like the best recent record, the last quarter, the last year, even the last couple of years, because they place a lot of weight on that as a criteria because they want to invest with successful people. It's not, by the way, wrong to want to have a good track record in your fund manager. You should, but first it needs to be over a very long period of time, and most people focus on very short, irrelevant periods of time. Incidentally, the fund management industry actually encourages that because they're very cynical. Not everyone, but a lot of the firms are cynical, and they just market the heck out of their recent good performers. And then when those don't do that well, they market some other fund. It's well known in the industry. But unfortunately, what happens is the investors buy high and sell low. They chase recent returns and they don't do very well. They actually do far worse than the underlying funds themselves. So that's a pretty bad way of selecting managers, of asking who did well last year. So what are the things you should look for? Well, there are three things, and I'm going to list them in the order of importance because that's the right order to think about. The first is integrity, and integrity means if the fund manager could do A, that's better for him or his firm, and or B, that's better for the client but not as good for the fund manager, that they choose B, and that's very rare. The business is full of people just trying to make as much money as possible, and they really have, as long as they stay within legal bounds, few other objectives. So you need to look for evidence of actions where the manager is doing something to advantage the client at their own expense, and that's what people should be doing as fund managers because they accept the trust over people's money, and that's important. The second is temperament. So that's number two, is temperament. And what does temperament mean? Temperament means that when you're under duress, stressful environment, the markets are turbulent, or maybe you as the manager are not performing very well recently, that you're able to stick to your process. Because the best process in the world isn't really going to help you if you can't stick to it, right? If you have a PowerPoint with amazing slides of what you will do, but then when the proverbial shit hits the fan, you actually don't do it, and you deviate from the process in meaningful ways based on your gut instinct or fear or behavioral biases, then that process isn't worth anything because when you need it most, you don't actually stick with it. So you need to see evidence of how do managers perform as far as sticking to their process under duress. So you want to find a period in the manager's experience when they weren't doing well, when things were going against them, and check their process. How did they make decisions, and look for deviations from the process as kind of a red flag to look for. And last, number three, is a high quality investment process. And that's very important because a lot of people in this industry, they dress well, they look good on CNBC, they're very telegenic, and that's awesome for their marketing efforts, but they don't actually have a process. They're kind of winging it. They're reading the Wall Street Journal, watching the talking heads on TV, and they're kind of investing based on hunches or half-baked ideas. And sometimes they'll be successful, sometimes not, but that's not the same as having a well-developed process. And that, by the way, doesn't mean that there's only one good process. I have a process I'm very proud of that works well for me, but that doesn't mean that that's the process everyone else should have. People might have a very different process, and that's fine as long as it's a well thought out process that plays well to their strengths and minimizes their weaknesses, and that they stick to. So they need to have a process that identifies good investments, that basically outlines how they're going to research those potential investments once they've identified the candidates, and then how they're going to construct a portfolio from the investments that pass that due diligence. So that's very important. So to summarize, you want someone with integrity to put the client's interests first, not just in the marketing pitch, but in reality. You want someone with the temperament to remain calm and rational under pressure, and you want someone with a high quality process that is going to help them systematically take advantage of mispricings in the market as opposed to invest based on hunches. I hope this was helpful to you. If you like this, please hit like on this video and subscribe to my YouTube channel. Thank you, guys.